Good day, everybody. Still here, Daily Market Pulse. It's Tuesday, January 7th, 2014. So after 3 losing days, the streak is broken. Stocks snap back. Everything's up, or for the most part, higher with higher volume on the indexes today. So after a higher volume day on the downside yesterday, we have a reversal. Distribution days are still very high, 7 and 7 respectively, NASDAQ, S&P. Everything closes back up over the 8 moving average. We had most indexes below yesterday, except for the Dow. Everything's back up and over again for now. So we'll look at charts. So Dow Jones here on the screen, you can see almost flag-like formation. We had a bear sash formation on the first trading day of the new year, declining from there. Nothing major, nothing aggressive, but the rising window was broken. That occurred on the 31st and closed below it at this point. Now the 8 moving average is holding. You have another window slightly below. That may be another level of support, including all the way down into the 16,200 level. That would coincide very closely with the 20-day moving average. I'm going to get rid of this little channel here because there was a channel there before. I'll get rid of that channel. Another one may be forming, and it could be a similar size, possibly. We'll see. But higher volume day, usually when you have a consolidation like this, it's lower volume, not higher volume. So you have 2 consecutive higher volume days. Kind of interesting. New high formed for the last 3 days today. New low yesterday. So we'll see how it all goes. Not quite oversold, but it doesn't always have to be. But nonetheless, probably more consolidation at the moment for now, kind of a sideways to downside slide for the time being. I would think would be the occurrence. We'll see if that's the continuation or not. There was a buy signal, mind you, today, but it still needs to clear above 16,600 ideally to truly be bullish. Let's look at the S&P. S&P has similarities, 3 consecutive down days after, again, a bear sash formation the first day of trading. In fact, that was the first downside day for the first trade day of the year in, I think, several 5-6 years or something like that, where we've seen always an upside day for the first day of a new year. Not so this year. Nonetheless, downside days, again, closed below 8 moving average temporarily and then bounced back. It's got room still to 1815, the breakout zone, breakout area, to maybe test that as support still. That's still possible. Otherwise, again, a break above the bear sash. You're looking for a long position. Otherwise, anything below 1815 probably takes you down to 1780 once again in a more sizable correction. Let's take a look at the NASDAQ. Okay, NASDAQ. Same thing, 3 consecutive down days again. It was a little bit higher. Rising window was broken almost immediately on January 2nd, and then a decline from there into the 20. It did not quite come down into the breakout area at the 40.75 or 40.77, but it did come into the window. You can see the window there. Let me do this so you can see this a little better. There we go. You can see there's a window right here. That window right there, that gap, people like to call that a gap sometimes. That's going to hold as support, or at least you'd expect it to. That's an area that's going to watch out for. And sure enough, it came into that level, held, bounced, bull sash today. But again, you're still looking at trying to clear 41.77 as a high. That occurred here on the 31st, New Year's Eve. 41.77.73 is the high. It needs to clear that, at least the bearish engulfing high, 41.73. So it needs to get into that area still to truly be bullish. If it can close above that, that's what you're looking at. Outside of that, trends are still up, obviously. Moving average is still higher. Higher highs, higher lows. All is consistent and intact. You've got this larger support way down here from an old window way back. That is going to be, who knows if that'll ever get tested and when that'll get tested, but nonetheless, I think I'll get rid of some of these other lines, get rid of some of the clutter. Yep, I think that's about it there. So NASDAQ needs to clear above the bearish engulfing, otherwise a drop below this window area takes you back down into the 4,000 region potentially. Let's look at the TSX for our Canadian friends. Okay, big slide. We know that occurred, and then it bounced, came all the way back, broke above the change of polarity. Didn't quite make it to the 1272, but at this point you might expect, or at least anticipate, that it might make it up to that level now, 13.7 to 13.744. in the top of the Bollinger Band currently right now as well. So all trends are still up. It never got oversold, but it did come back to the polarity area and bounce. This is what you'd expect on the other U.S. indexes. It did not quite happen. It did so almost perfectly and in perfect fashion, in a sense, as you might expect on the TSX. So it's acting and behaving more predictably. Nice reversal today. Again, needs to clear. Right now, the way things are looking here, another green candle, and especially if it can close above the highs, which is almost there now, you're probably looking at, again, that higher level almost immediately as a target. Below 13,470, you're looking at a lower target as deep as 13,100. All right, let's look at the treasuries. Treasuries finding support appears based on a prior pivot way back here, and I kind of did that loosely because this is essentially where it found extra support. Really, this can be a much larger one. In fact, I can almost make another one. I'll do that right now. Into this area right here, kind of like that. I can drop that down, make it a little narrower, kind of like that. That's kind of the support area you'd be looking for as well, potentially. So there's a lot of support down here. It just happened to take it at the 128 level. Held a bull sash, bullish piercing, bullish engulfing, a lot of bullish candles. Ultimately, you still need a bounce. You still need a close that's higher, and it did so. It closed finally today above the 20-day moving average. So we're looking for more activity to the upside for the treasuries. The next target would be 130. Not quite 131, but 130, and possibly as high as 131, but certainly 130 initially would be the thought here first and foremost. Downside, of course, support all the way to 128. Below that, you're looking at 127, maybe 126, but 127 on the downside if it ever reverses lower to retest those levels once again. 128 would be a certain retest. A break below 128 takes you to 127. Let's make it clear. Okay, the yen might be important to look at. The yen was that support, bull sash, bullish engulfing. And this is where you got to be careful. If people see these bullish candles, they see these bullish reversals, they think automatically it's a buy signal. Not necessarily. The first one did bounce on a dead cat bounce after all this selling. Certainly that was reasonable. Went up a percentage and then came right back down to retest, bounced again a little bit. Those are great trades, but they have to be quick and nimble. And unless it holds, then you're looking at more downside. Sure enough, you need to immediately reverse a trade that's long to the short side on a break below, particularly on a close below those support levels. And sure enough, it did. A gap lower. It was almost an immediate entry on that, unless you were anticipating based on with that activity on that FOMC date that prices would go lower. You would have been in that even deeper. So you go lower after a few days, it sinks quite rapidly. Of course, it's made some of that in terms of retracement, but it's still declining. The trend is still lower. The 8 still coming down for the most part. The 20 clearly is. The 50 clearly is. Look at the gap, however, the width and the space between these moving averages. At some point, this is going to slow down and start to come back up on a short squeeze, and perhaps some kind of a rounded bottom formation as well. So 3 days up and then a couple days to the downside as a possible retrace. It may come back to retest this 95 level. Certainly that bullish engulfing is pretty enticing as a very strong reversal candle. But in terms of percentage retracement from high to low, this is almost pretty much accomplished already. So if I show you from the low, the bullish engulfing to the high, where it really started to sink, you can see it's already retraced back to the 618. And that's pretty classic. That's pretty typical on a kind of a dead cat bounce kind of formation. After a lot of selling, that you'd see at least a retracement to that level. If it's more aggressive, it goes 50%, which might take you back into 96.50, but right here, this is probably sufficient at this point. So possible retest of the bullish engulfing into 95.20, maybe as low as 94.85, but right now neutral and kind of consolidating for the most part, and just keep an eye on its downside until you see perhaps another bounce intraday. Let's go right over to gold. Gold also looking like it's finding support here at 1180 to 1200. In through here, again, based on another previous low dated back to June, the end of June. A little bit of a roundedness here in terms of its bottom. Moving average is trying to cross over, decent move into 1250. It's trying to hold here at 1225 to 1220. If it can and bounce higher, looking back to regain a footing near the 50-day moving average at 1250 to 1260, or 1255 to 1260, pardon me, and then as high as maybe 1270, 1280. So reasonable there. Even though it is oversold right now, it's consolidating, looking for another refresh and another push higher, potentially based on some of this bullish activity we've seen here recently. Let's go look at crude. Okay, crude had its bullish activity on the way to the upside. All the moving averages were starting to rise. The 8 was up, the 20 was up, the 20 across the 50. The 50 was still declining, so the intermediate trend was still intact and influencing certainly the activity of oil. We had said if oil could break 99, you're looking at 101 to 103 on the upside. Well, it made 101. The high, in fact, was 100.75, so close enough. Immediately a reversal signal on the bearish side, but you still needed to have a close below 99. It did so the following day, and then of course sayonara all the way down, huge sell-off back to support at 93 to 94, and then it held. Harami of sorts, spinning top yesterday, or pardon me, today, and a gap higher already after hours. So this is already looking for some kind of a dead cat bounce back again, as we said earlier, maybe a 764, but certainly up to maybe a 618 retracement. If we look at what that might be from there to the high, we are looking at something as high as maybe $96. But you might start thinking about essentially 95 first, to maybe 96 thereafter. So don't chew off too much too fast. But that's you might even come back and retest 93 and go lower again into 92. So just be careful. Right now, there's at least some activity. It's not super bullish, but it's certainly expecting some kind of a bounce after a huge sell-off like that. All right, let's look at small caps real quick to see if a risk is on. And I'm not sure I'm real convinced that risk is truly on, that the markets are truly going to go higher with small caps looking like this. They had failed, and they went higher, yes, and they went sideways with multiple spinning tops and doji, falling window, which has not yet, in fact, been retraced back again. So, like we showed you earlier on the window on the downside for support, we're going to see a window that's right, a small one, mind you, but right here is a small window right across here right now. Come on. Cooperate, please. I don't know what's going on with my chart here, but it's okay. There we go. Window right across there, okay? So that window right now is resistance. Window there came up, bearish engulfing. Window there came up yesterday, today as well. Window is still acting as resistance. It needs to close above that into 116 to truly become bullish. Once again, right now, not real convincing. Again, another polarity area maybe here at about 114 or slightly lower. Anything below that, you're heading lower, much lower. And that might be a sign that the markets, in fact, will be selling off, as we may anticipate. Let's go to the VIX. So this is what's interesting with the VIX. The VIX came all the way back down on that rally, of course, formed a hammer on the day that the markets were very volatile with the FOMC. Formed a hammer and then eventually reversed, a rising window back into the sideways moving and directional moving averages, 220, the 8 and the 50, all respectively currently today in that order, all going sideways. Price action in the midst of that, except for today, gap lower back to its usual place, back down into the 1225, 1235, almost 1250 level, and immediately reversed back to the upside to fill the gap. So that gap is filled for the most part based on the shadows, but not necessarily the close, but nonetheless. Pretty interesting reversal here. I think we need to keep a close eye on this, as well as the markets, including small caps, just to see if, in fact, this is getting a little tired in the markets. Markets may start collapsing or falling apart, selling off a little more aggressively. Again, with the fact that there's still 7 distribution days on both the S&P and NASDAQ, that's a lot to overcome. So this is getting a little interesting here as the VIX seems a little antsy, a little jittery. We'll see if it pops back up toward 1450 or 15. If it breaks those levels, then again, my original targets way back was 18 to 19. It only made it to 17 the first time on the first go around. Let's see if they're finally going to sell this market off as they have. For the whole year of 2013, the biggest sell-off that we ever had was less than 6%. It was about 5.7%. Those are not classic and typical correctional type percentages. 5 to 5.7 is not what you'd expect. You're expecting 10, 15, 12, 15, 20%. Those are good, solid corrections. Now, we had multiple corrections, mind you, of 5% or more. We had a lot of them. That's why the markets were able to at least sustain the rallies and sustain the trends that they've had. So we've had more of them, but in smaller percentage amounts. So let's see what they do here going forward, especially as they head into unemployment and non-farm payroll on Friday, and see how they react to that. All right.